Hello and welcome to this video on financial analysis. Today we would like to analyze the financial stability of a company, and I try to do a bankruptcy prediction. For this video I plan the following. First, I would like to go into reasons for insolvencies or for bankruptcies with a special focus on Germany. Then I would like to show some ratios, how to detect over-indebtedness, and some ratios, how to detect illiquidity. Last but not least, I would like to go into some modern approaches for insolvency prediction. A company crisis is typically seen in different phases. It starts with a stakeholder crisis. The stakeholders are all persons who hold a stake in the company or who have any interest in the company. These stakeholders might struggle about the strategy of the company, and thus the company tumbles into a strategy crisis, which means that the company does not choose the right strategy to survive on the market or does not use its resources efficiently. Due to the strategy crisis, sooner or later, the company will run into a product and sales crisis, which means that the company cannot sell its products or services at a decent price, which leads to a profitability crisis, which means that the company is not that profitable anymore. The revenues are not high enough and the costs are not covered. Last but not least, the profitability crisis turns into some liquidity crisis, which means that the company is running out of cash. And at the end of this process, we see the bankruptcy or the insolvency. What is special with those phases is that the scope of action, so what you can do, is narrowing down. In the stakeholder crisis, you have many options. In the strategy crisis, these options become fewer and fewer, and thus your scope of action is going down and down and down. And in the end, you can't do anything anymore to come over the crisis. And since at the end of this process we see the insolvency, we need to have a look at the reasons for insolvency. And this is the special focus on Germany. These are the reasons for insolvency after German law. We see over-indebtedness as a first reason. Over-indebtedness means that the assets do not cover the liabilities or that the equity is negative, which is exactly the same as assets do not cover liabilities. What's the relevance of this? It is indeed very low for the filing. Only very few companies file for insolvency due to over-indebtedness. The reason is very simple. If we go back to the last slide, we see that the profitability crisis comes first, and typically then comes the liquidity crisis. So companies typically wait until the very end, and that's the liquidity crisis that will make them file for insolvency, and not any profitability or equity crisis. But, of course, the over-indebtedness is very important for the prediction. In fact, 80% of prediction accuracy comes out of ratios analyzing over-indebtedness. The legal basis after German law is paragraph 19 Insolvenzordnung, which is the German law on bankruptcy. The second, but much more important reason for insolvency is the illiquidity. The illiquidity is given if the company is not able to pay its dues. Here the relevance is very high for the filing. Why that? First of all, again, the liquidity crisis typically comes after the profitability crisis. So usually this is the last phase of the crisis. But there's also a second reason. To detect if a company is over-indebted means having a financial report in place. And typically smaller companies only make or compose financial reports once a year. So often over-indebtedness stays undetected. And over-indebtedness can't be seen from outside the company. So it's up to the management to decide whether to file for insolvency or not. Although, of course, they are legally obliged to file for insolvency. Illiquidity can be seen from outside the company because there will be definitely someone who's waiting for his money. And the filing for insolvency must not only be done by the management, it can also be done by a creditor. So the relevance here is very high because a creditor waiting for his money might go to the court and file for insolvency, even if the management is not willing to. Accordingly, we come to the third reason for insolvency, and that is prospective illiquidity. What means prospective illiquidity? It means that the company is not yet illiquid, but it is foreseeable that this is the case in next to no time. For example, an invoice is coming in and the management is already aware of the fact that the company can't pay this invoice. So payables that are not yet due cannot be paid prospectively. This is very, very high in its relevance because the directors have to file for insolvency if they already know that the company is in trouble. So the directors might be personally liable if they delay in filing for insolvency, if an illiquidity is foreseeable. Here again we see the legal basis, so we have 17, 18 and 19 Insolvenzordnung. To detect the over-indebtedness of a company, of course, we need to take a look at the debt. So, what is the debt of a company? The debt of a company, of course, is long-term debt, but also deferred income tax liabilities, and, if we define it like that, also all the current liabilities. So here we see current and non-current liabilities. So this can be defined as debt. But in modern textbooks, we often see the opinion that the current liabilities and the non-current assets, the current assets, that the current liabilities and the current assets together are the working capital, and thus current liabilities do not count as debt. So there are different opinions towards how debt is defined to be over-indebted. Due to the law, of course, over-indebtedness includes both the current liabilities and the non-current liabilities. Nevertheless, we follow the textbook opinion and we exclude the current liabilities here, but we can write down both, nevertheless. And of course, we have to watch for the equity, because if the equity turns out to be negative, the company is also over-indebted. Now, we can calculate a ratio of the liabilities as of total liabilities and equity, and we can define this as the debt ratio. The higher the debt ratio, the higher the probability of an insolvency. Or we can divide total equity by total liabilities and equity and define this as the equity ratio. The higher the equity ratio, the lower the probability of bankruptcy. Let's write that down. Is defined as, I use abbreviations here, current liabilities and non-current liabilities in relation to total liabilities and equity. So this is the usual textbook formula. And here, of course, we can put some numbers in. So here we have 26,973. That's this. Plus 38,310, like this, and divided by 86,381. So here we see a debt ratio of 75.6%. If we now calculate the equity ratio, of course we divide the equity, EQ, by, and in this case, total liabilities and equity. So here we divide 21,098, check mark this, and of course those 86,381. And that will give an equity ratio of 24.4%. And of course, however we define the debt ratio or the equity ratio, the debt ratio plus the equity ratio always add up to 1. So 75.6% and 24.4%, that's 100%, and that's 1. So 100%, and that is 1. Now I would like to come to the other definition of those formula. So the other definition that I just mentioned Then we define the debt ratio. Or I just write down modern approach. And in the modern approach, we just ignore the current liabilities, because the current liabilities are part of the working capital and they are taken net of current assets. Accordingly, the debt ratio is just given by non-current liabilities divided by, and of course we cannot use total liabilities and equity here because it still includes the current liabilities. That won't work. So we use the equity plus the non-current liabilities. So here the ratio would be 38,310 divided by 21,098 plus 38,310. And that is 64.5%. The equity ratio, accordingly, is defined as equity divided by equity plus non-current liabilities, and that is 21,098 divided by 21,098 plus 38,310, and that is 35.5%. And if we define debt ratio and equity ratio like this in this modern approach, again, 64.5% and 35.5% add up to 100%. So for consistency reasons, we need to have this. What we already have learned in an earlier video is the leverage ratio. And the leverage ratio is not a percentage, but some kind of multiplier. And of course, here we can again use both definitions. It is just debt divided by equity, but how do we define debt? Do we define it as current liabilities plus non-current liabilities or only non-current liabilities? So on this page, we already have the modern approach. Accordingly, I just write down non-current liabilities divided by equity. And in this case, the leverage ratio would be 38,310 divided by 21,098. And that is, so would we like to write it down? 1.81 or 181%. So we apply 181% of the equity again by debt. So this is the meaning of the leverage ratio. Let us now define ratios for detecting illiquidity. So what is liquidity? The liquidity is cash and cash equivalents, of course. And this is our liquidity. My first idea about calculating something like cash ratio was to divide the cash and cash equivalents by total assets. This is a very natural idea, and it is not wrong, but there are better opportunities than this. There are better definitions. That's why this ratio is completely unknown in the textbooks or not in use in practice. Why do we have better definitions? Because we already know about the term structure of our debt. Our debt are the non-current liabilities, but they are long-term. And that means longer than 1 year. And we have the current liabilities, and they are short-termed. And that means shorter than 1 year. So the cash and cash equivalents can be put into some relation with the current liabilities. So what is due within 1 year? Let us define the cash ratio accordingly. So the cash ratio is defined as, I just write cash, but I mean cash and cash equivalents, of course. Cash divided by current liabilities. Because the cash is used to cover the current liabilities within 1 year. So in this example, we would now calculate 7,947 and divide that by 26,973. So check mark this and check mark that. And the cash ratio here would be 29.5%. 29.5%. If we go into a discussion with the management of this company, the management would argue differently. They would say, okay, cash and cash equivalent is what we currently have at hand, the liquidity that we currently have. Nevertheless, we do have accounts receivables. And those accounts receivables are all due within the next 30 days. So even if some of those customers won't pay, nevertheless, within 30 days, we have this amount of money. We have this amount of money quickly. And that's why we define the quick ratio. So the liquidity that we have quickly as cash plus accounts receivables, and divide this by current liabilities. And in our example, this would be 7,947 plus 7,199 divided by 26,973. And that is 56.2%. If we now continue our discussion with the management, they will say, well, wait for a second, we still have the inventory. And we have some finished goods here, like cars, for example, if we produce cars. We will sell those cars within a few days. And then we send out invoices. So these finished goods will be sooner or later accounts receivables, and at least 30 days later they will turn into cash. The same is true for the work in progress. Because the cars are now on the assembly line, sooner or later they will become finished goods. Out of finished goods, we will have some accounts receivables, and out of accounts receivables we will have cash, and that will happen in less than 1 year. And the same is true with raw material, because the raw material will turn into work in progress will turn into finished goods, with finished goods, cars that we sell, will turn into accounts receivables, and those accounts receivables will be collected, and we will have cash and cash equivalents. So within the 1 year that we have, less than 1 year that we have to cover the current liabilities, all this will turn into cash. Accordingly, the current ratio is defined as cash plus accounts receivables plus inventory divided by current liabilities. But if we take a look, what is cash plus accounts receivables plus inventory? These three items together are current assets. So this is exactly the same as if I write current assets divided by current liabilities. So in our example here, we would now divide 20,411 by 26,973. And the current assets are defined as assets that are typically in the company for less than 1 year. So this is in line with this. So what's that? That's 75.7%. What is healthy here? Healthy here would be a current ratio of 1 or 100%. Why that? Because we need to cover the current liabilities that are due within 1 year with the current assets that turn into cash and cash equivalents within 1 year. Accordingly, a coverage of 100% would be healthy. A coverage of 75% might lead to some shortages in liquidity within the next year. So this could be an unhealthy situation if it is left unmanaged. Now I would like to take a closer look on modern methods for insolvency prediction. The basic idea of insolvency prediction is that we consider a bunch of companies. Let's say this bunch of companies, 8 companies, will be taken a closer look at or will be analyzed. And we take a look at their financials in year 0. So we take a look at the typical ratios like the equity ratio or the current ratio and others. Of course, that's why we see ... here. And after 1 year, so in year 1, we again take a look at the same set of companies. In this set of companies, there will be some who survived this year properly. But some will have filed for insolvency due to their economic status. And now the idea is to find out if there is any connection between the equity ratio, the current ratio, and other ratios, and the case that they went bankrupt or not. A very simple approach is the simple discriminant analysis. Simple because we only take a look at one of the considered variables like the debt ratio or the equity ratio. And if we now see several companies that have a low debt ratio, the probability that they went bankrupt is rather low, while those with a high debt ratio, the probability that they go bankrupt is rather high. If we now analyze the distribution of those that went bankrupt and those that did not went bankrupt, of course the distribution of the equity ratio in year 0 as a predictor for the bankruptcy, we see that we have a certain distance. The distance between the mean of those who went not bankrupt and the mean of those who went bankrupt. Of course, this distance in means is a very good measure of discrimination. So if this ratio is very good in discriminating the good and the bad companies here, the distance should be rather high. If the discrimination is worse, the distance in means should be rather low. If we see that one of our ratios is good for discriminating those who go bankrupt and those who don't go bankrupt, we need some kind of cutoff point, so the discriminant or the discriminant function. For example, we can simply choose this point where those distributions intercept. But this is not necessarily the case. So if the loss of a company that goes bankrupt is severe, while the profit of a company who does not go bankrupt is rather low, we can also shift this cutoff point further to the right or further to the left, depending on the situation. I would guess that banks, for example, who fear severe losses from bankruptcies, will rather go to the left and sort out more good ones than to suffer losses from the bad ones. So this is also a trade-off in cost. The cutoff point is not necessarily the point where the two curves intercept. If we now go into several dimensions, we can use the multiple discriminant analysis, MDA, and we can use something like a discriminant function, like this line. What do we see on this chart? We see the debt ratio again, and we see that the bad companies often have a higher debt ratio, while the good companies rather have a low debt ratio. But On the epsilon axis, we now see the current ratio. And of course, the good companies will rather have a high current ratio, the bad companies will rather have a low current ratio. Accordingly, we are looking for that discriminant function that can decide or that can discriminate between the good and the bad companies as good as possible. So the same idea than the simple discriminant analysis here in a multidimensional room, MDA, multiple discriminant analysis. An even more modern method of insolvency prediction is the so-called logistic regression. The logistic regression is very closely related to the normal regression, to the OLS, ordinary least squares regression. But what do we see here? What's the basic idea here? The basic idea is to adopt a logistic function, that is this function here, a logistic function to the data that models the probability of bankruptcy. How does that work out? We have the debt ratio here again, and we know that the bad companies all have rather high debt ratios, while the good companies rather have low debt ratios. And the bankruptcy here is modeled with a 0 or 1 as a dummy variable, 0 or 1, so that we have the good companies down here with a 0 and the bad companies up here with the 1. And now we need to adopt this logistic function here, and that's a beautiful function because it strives to 0 the lower the debt ratio, and it strives against 1 the higher the debt ratio. Accordingly, we can model the probability of bankruptcy induced by the debt ratio. And since this method is not only restricted to one variable, but we can use it even in a multiple form with several ratios, we can use logistic regression as a very, very modern instrument for insolvency prediction. Thank you for listening. See you in the next video. Bye-bye.